Deductions and credits both reduce your tax bill, but are not the same thing. So what is the key difference between the two? Let's break it down. A deduction reduces your gross income, giving you a smaller amount of income to be taxed. On the other hand, a credit reduces the final bill after deductions have been taken, which is almost like being given cash to help you pay your tax bill. To make it clearer, let's see all of this in an actual example. In my previous videos, I guided you step by step on how income tax is calculated by using a fictitious single taxpayer. With salary of $80,000, only a standard deduction and no credits, having the correct withholding on his W-4, he virtually broke even with a tax bill of just 12 cents. Now, let's alter this scenario with a deduction for retirement contributions, another deduction for investment losses, and a credit for tuition expenses to better see how this all works. For the retirement deduction, our taxpayer contributed $100 per paycheck to the company retirement plan, which after 26 paychecks totaled $2,600. This is under the IRS limit, so we can deduct the entire amount. For the investment losses, our taxpayer sold some stock during the year at a loss of $4,000, but he is only able to deduct $3,000 per year in investment losses, so we're going to deduct the $3,000 and carry the remaining $1,000 loss forward to next year's taxes as a deduction. Lastly, our taxpayer wants to level up in this competitive job market and so decided to get his MBA. He paid a total of $5,000 in tuition. This is a qualified education cost and makes him eligible for the lifetime learning credit. The credit is 20% of your expenses, your qualified education expenses, up to a limit of $10,000 total in expenses. With $5,000 in our example, the credit comes to $1,000, which is 20% of that. First, let's calculate our deductions. We have $2,600 for the retirement contributions, plus the maximum limit per year of $3,000 for investment losses. Altogether, this reduces our gross income of $80,000 down to adjusted gross income of $74,400. We now apply the standard deduction for single filing status of $15,000, which further reduces our adjusted gross income to taxable income of $59,400. We then apply the tax rates for single status to that $59,400, and this results in a tax bill of $7,982. Finally, we move to the credit calculation, which will be much easier because we just simply take the tax bill and reduce it by the $1,000 credit, taking our final tax bill down to $6,982. Now let's compare this to the original scenario. We started with tax paid through paycheck holdings of $9,213.88, but the retirement contributions of $100 per paycheck actually reduces the amount of tax withheld from each paycheck. So we experienced tax savings even before the end of the year with those retirement deductions. So at the end of the year, we actually have total tax withheld of $8,641.88. Now, under this new altered scenario, when we compare the tax withheld with the taxes charged after deductions and credits are applied, we see a refund of $1,659.88. Recall in our original scenario, without those extra deductions and credits, that our end of year balance was 12 cents. That means we saved $1,660 through deductions and credits. And also keep in mind, this includes $2,600 that is growing towards your retirement. I hope these tutorials help you to be more proactive about your tax planning before the next tax filing season. And if you need help with your taxes or your IRS tax debt, be sure to book an appointment with us at Tax Navigator Solutions. Until next time, ciao for now.